Well, good morning, traders and investors. Today is September 4th. It's a Friday. Yesterday, the market had what I call a beginning of a sell-off. And right now, if you look at the futures, the Nasdaq 100 down 170, while the E-mini S&P is down just 12, and the Dow is down 6. And if you look at the future months on the Dow, it's up 32. So you could see that there is a serious meltdown going in the Nasdaq sector. Now, I hate to say I told you so, but boy, oh boy, I've been telling you so. Look at the momentum levels. That's the number of stocks in the Nasdaq 100. That's the troublemaker yesterday that were trading above the 200-day moving average. Look at this line. This red line shows you, this is a 20-year chart. This is actually going back 12 years, 12, 13 years. Let's see here. Yeah, about 12, 13 years. But you could see here, anytime we get above this orangey red line, what happens? It doesn't stay there very long, right? It comes right back down. Goes up and then comes back down. Well, look where we're at right now, and we're coming off of that bounce low that we had. And this is danger zone. Look at this, danger zone, danger zone, danger zone, danger zone, danger zone. Anytime more than 80 out of 100 stocks in the Nasdaq 100 go above the 200-day moving average, the market sets itself in trouble. Now, if you look at the 50-day line, I've been talking about this. If you're going to tell me, Roger, why haven't you been talking about this? Folks, look where I circled this. I want to show you how far back I was talking about this. I was talking about this around April. I circled this in April, and it was the high. Whenever you see about 99% of stocks trading above the 50-day moving average, first we talked about the 200-day moving average. Now we're talking about the 50-day moving average. It's too much. Now look at the momentum levels. They're moving lower. That means the market has been going higher since April, but less stocks have been driving it higher. And again, everything I'm telling you right now, I've brought to your attention at least 36 times over the last several months. So none of this should be new. None of this should be breathtaking. None of this should be news for you. This is what we've been expecting, especially in the Nasdaq sector. And I believe, notice, every time we hit anything above this level, we go all the way down to the 20th level. We go from 80th to 20th, 80th to 20th. We went all the way to 99th. This thing is going back down to 20th. So you got to be very, very cautious. Now, today we have employment data. We've got the expectations is 1.4 million new jobs. That's what we're looking for, 1.4 million. Sorry, my mind is going off. I'm looking at the unemployment number. I'm always focused on the unemployment number. The unemployment is supposed to be 9.8%, and new expectations for hiring is supposed to be 1.4 million. Last time we had 1.7 million. The consensus range has been low, but we did rise to 1.7 million. Now we're looking for a rise to 1.4 million. But look at the range. This is how much confidence analysts have in Wall Street. The range, whenever you see a range that's all over the place, that's very, very bad. 435,000 to 2 million, bad. I would just focus on the unemployment rate, honestly. 9.8%, not bad. If we can go below 9.8, remember that number. Below 9.8 is good. Below 8.5 is really, really, really good. But again, the market overnight, it's not doing all that great, and the report comes out in about 20 minutes. We may have a little congestion, but I think we're going to see more downside. Let's talk about global economy, and then we'll go back into price levels. So U.S. futures bounced back? Not really. I mean, the S&P did, but Nasdaq not. There was little going on in Asia to alter the market's downward trajectory after U.S. benchmark S&P gave up 3.5% on Thursday, its biggest loss in a quarter. And the Nasdaq fell 5%. That we were waiting for as high-flying tech companies tumbled. There's still plenty of money sloshing through financial systems, with the Federal Reserve and many other central banks unleashing massive amounts of cash through bond purchases while keeping interest rates ultra low. And but for that, the markets would be in really, really bad shape. Thursday's unloading of tech companies ended up with Apple plunging 8%, Amazon losing 4.6%, Facebook losing 3.8%. Again, none of this is a big surprise, especially after I showed you those momentum levels. You've seen those momentum levels right here. This should not be a surprise. Even with Thursday's losses, though, Apple is up 64% for the year. Not bad. Amazon, 82, and Zoom, 460. The gains have been based on rosy assumptions about virus's impact on the economy, more, I think, on the amount of money coming into the market, as well as on prospects for Congress and White House coming up with another economic relief package. Absolutely, no question about that. This is about the report that I talked about. Investors will be paying close attention to Friday when Labor Department releases its August job report. Economists expect forecasts created 1.4 million new jobs in August. That's what I'm hoping for, down from 1.74 million jobs in July. And again, look at the range. They're looking from 435,000 to 2 million new jobs. Range is 1.4 million. I would really, if the number is in line with consensus, 1.4, 1.5 million, anything above 1.4 million, 1.5 is good. And unemployment, anything below 9.8 is okay, and anything below 8.5% is great. And that report's going to come out very, very shortly. Now, crude oil. I've warned you about that too. Crude oil now, frackers in the U.S. have to pay more than $41.68. They have to pay about $42.50, I believe, $43 per barrel. So frackers are losing money when crude oil is below $42, $43. That's going to cause a bigger impact on the downside of the energy market. Matter of fact, let me take a look at the energy market. Right now, it held up pretty steady yesterday, but now it looks like it's moving lower. And again, the trend is lower. It hardly bounced back. It's been a market that is near the July lows already. And I think we're going to see more downside. Remember something. Liquidity, this Fed liquidity causing alt markets, S&P to go all-time highs, it causes all markets to go up. It's like waves in the ocean. Anything that's there will move higher. But as soon as the market gives off, the weakest sectors are going to be down the most. Now, what should you be looking at right now? On a 1-month basis, remember when I told you guys that we're starting to see fragmentation? Remember I told you tech and consumer discretionary are going to move down? Basic materials, consumer staples are going to move up? Well, this is the average. Let's look on a 1-month basis. 1-month basis, technology is already in 4th place. Basic materials and industrial, I told you so, are in 2nd and 3rd place. And soon, if technology is already in 4th, you're going to see consumer discretionary move down along with tech, and industrial and basic material move in 1st place. Now, if I were you, I would be looking at defensive stocks right now. Defensive stocks, let's look at some defensive stocks. FedEx is a defensive stock. UPS is a defensive stock. Quanta Services is a defensive stock. Deere is a defensive stock. Rollins is a defensive stock. Tractor Supply is a defensive stock. Lowe's is a defensive stock. Those are defensive stocks. Now, I just gave you a list of the top defensive stocks in the S&P 500. In terms of where we're going to go and how far we're going to go down, let's take a look at the SPY real quick here. We're opening down slightly lower, but we're holding up. Keep your eye out on the 342 level. If you're trading the large S&P, look out for the 3,400 level. If we break down below, if we start trading into the 3,400, below the 3,420 level, we're going to go lower. If we break this, we're going to go lower. Now, I'm expecting this to potentially go down to the 50-day moving average, which is near the 330 level. If you look at the QQQ, we are already at the low, and I think we are going to break below. And between you and I think we're going to go lower. And I also think we're going to bounce to the 50-day moving average, especially with the momentum levels of where we're at. So keep your eye on defensive stocks. Look at energy. Look at gold. Don't look at energy. Look at gold. That's defensive. Gold is up a point right now. Look at T-bonds, TLT. That's defensive. I think we're going to see a nice little rally on T-bonds. If the S&P breaks below the 200-day, the 50-day moving average, the bonds will break above the 50-day moving average. So look for upside in the bond market and look for volatility to rise. And again, folks, None of this should be a surprise for you. I told you about this a long time ago, back in April. Look at this. Look at when I circled this line. I haven't changed it. This line was done around April, May. Look at this. We went all the way 98% of stocks trading above the 50-day moving average. Now we're at 67% of stocks. But look at the price of the QQQ between now and that period. Look at this. Straight up. Straight up. Just like it happened prior to the correction. Divergence, upside, narrowing of momentum, same thing here. Up, 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 up. We've been going up. We went up from like 240. Yeah, from like 240 to 300, while instead of 90% of the stocks are causing the upside, only 70% or 60%. The bottom line is we're seeing narrowing of momentum. Here we had 99 stocks. Here we have 67% of stocks. So there's like 30 less stocks trading above the 50-day moving average, but the NASDAQ kept going up and up and up and up. And I kept telling you, narrowing of momentum is very, very dangerous, and we're feeling it right now. So I wouldn't be surprised if we saw more downside on speculative and tech stocks and more upside on defensive stocks. Now, folks, I've got something important for you, and it's Friday. Pay attention. What would you do? What would you do if you can count down the days to your next big trade victory and achieve 350% return in less than 30 days? Can you imagine 350% in less than 30 days? Folks, the S&P 500 gives you 6% per year on average. We're talking 350% in 1/12 of that. Thanks to former hedge fund insider Lance Ippolito's free ride trading system, you can make that a reality. A reality, folks. You see, by exploiting a secret calendar, you can count down to timed stocks explosions, letting you turn $1,000 into $4,500 or $5,000. Or how about $5,000 into $22,400? I love these 4.5 time returns. I love it. I mean, 350% return, turning $1,000 into $4,500, turning $5,000 to $22,400. I love it. All in 30 days without risking a single penny of your initial stake. 350%, 30 days or less, without risking a single penny of my initial stakes. I'm in. I'm in. Click the link below to potentially earn 3.5 times your cash in September, especially while the markets are faltering. I'll talk to you guys soon. Follow the link below. You can't afford to miss out, and have a great weekend. Folks, if you're enjoying my videos, post below. Send me an email, support@marketgeeks.com. Let me know what you're thinking. Give me some feedback. Bye. Take care.